As expected, the Fed announced that they would cut interest rates by 0.25%. However, there is someone new who was on the Fed who says he wants to cut rates even further by the end of the year. So what exactly does that mean for the stock market and, more importantly, the entire economy moving forward? Let's go ahead and break it down. For those that don't know, the Federal Reserve is made up of Fed governors, one of which is the Fed chair, Jerome Powell. They all vote on a lot of the stuff that we talk about, like whether we raise or cut rates, so on and so forth. Now, Stephen Moran says that he wants rates down to about 2%. We're currently at right around 4%, and he wants to cut it down to around 2% by the end of the year. And it's September. It is September, which means you gotta cut rates aggressively to get rates all the way down to 2%. What happens when you cut interest rates? What happens when you cut interest rates? There are some positives. The stock market usually goes up. People usually spend. Also, your savings rate does go down, which is not a good thing, but people tend to spend more. And the last time we cut interest rates, inflation happened. This is what I've been warning y'all about. This right here is what I've been warning people about on Threads. This is what I've been warning about on this channel. I've been saying a recession isn't really what I've been warning about, which, yes, is a risk. It is stagflation. You got people trying to cut interest rates and you still have tariffs. So you're rushing out, pushing up prices, and you also have a weak economy. How do we know we have a weak economy? Yes, we saw job numbers earlier, but we've talked about what it is like getting a job in today's economy. Go on LinkedIn and see how rough it is trying to get a job currently. It is a fact that the economy is looking a little weak. Okay, so we have a weak economy. Spending has absolutely slowed down. We've already talked about how the top 10% of income earners, they are doing half the spending. The spending that we are saying isn't across the board. It's just rich people buying stuff. So we have, again, a weak economy, and we're seeing inflation. Cutting rates so aggressively right now is only going to make that worse. How do we know that? For example, now this is not a one-to-one comparison. When the Fed cuts rates, it doesn't automatically mean that mortgage rates go in kind. Okay, they're not a one-to-one. What happens is the Fed cuts rates, and when they cut rates, these are the rates that banks own each other. Okay, and based on that, that changes other rates in the change. It changes sometimes bond rates, credit card rates, savings rates, and kind of works its way up and eventually his mortgage rates. Okay, so again, when the Fed cuts rates by 0.25%, it does not mean that mortgage rates go and change by 0.25%. However, okay, for example, let's say that mortgage rates change by 2%. Again, this won't happen. I'm just giving you an example of how important rates are. If mortgage rates were to change from 2%, mortgage rates were to change 2%, so from 6 to 4, how big of a difference would that be? On a $400,000 house, a 6% mortgage versus a 4% mortgage, that's roughly $500 difference in monthly payment. $500 difference. Same house, $500 difference just because the interest rate changed by 2%. Now, over the entire mortgage, that's roughly $170,000 to $175,000 cheaper. Now, think about that. If you knew that rates were going to go down that quickly and it was going to save you that much money, what do you think you would do? You would go out, you would buy aggressively. That is what is going to happen if that were the case across the board. Now, yeah, it would try and stimulate the economy at least, but that also presses up inflation. That's the key. We saw this in 2021. Like I saw it when I was buying my house, when rates were extremely low, which my mortgage rate was around 3%, like 2.9 or whatever, and houses were getting snapped up. I had to pay like $25,000 more than what the house was truly worth. Yeah, houses are going to get bought. Yeah, some things are going to go faster than what they should, but it pushed up inflation. Y'all remember when inflation was 9%? Y'all remember when people were complaining about the cost of groceries? You pushed down interest rates so far, plus tariffs, People are going to try and buy up everything, try to outbid people for stuff yet again. Yes, you want to stimulate the economy. I said this. One interest rate cut might work. Maybe two. But if you push it all the way down 2% by the end of the year, I think that's the key phrase, by the end of the year, you could have stagflation a whole lot quicker than we need. We don't need it at all, but a whole lot quicker than you think and way faster than what we need right in time for the holiday season, which is not what you want either. So this is the thing I've been wanting. But wait, there's more. What do you do as an investor given all the news? Now, most of that was bad and scary and more of a warning, which you do need to know, right? But I'm more action oriented. Now, as an investor, right now you want to invest as normal. One person on the Fed does not make the entire Fed. All right. Now, I've been arguing and saying you want to keep the Fed independent. I've been right about that. There's a lot of stuff in the background happening with the Fed. If you haven't known, I'm not going to cover that here. If you want me to, I need like 3 or 4 people to say yes in the comments and we can do that. But currently, they're trying to change the people in the Fed for I'm going to just say reasons. But this is why you want to keep it independent. However, for investors, keep your portfolio the same. Because again, one person wanting to cut it by 2% does not mean it's going to be cut by 2%. They got to vote. If I'm not mistaken, I think it's 12 people on the board, so you can't just cut it just because one guy wants to cut it. But they may cut it, I think, two to three more times before the end of the year. I don't think anybody on that board is that crazy to cut it that aggressively before the end of the year. And right now we don't have that. And until such a time as those things change, you can keep your portfolio where it is. So whether you're just constantly investing in index funds, the market is still up. If you are investing in some of the stocks and stuff we talk on this channel, those should continue to be fine unless the status does change. So I wouldn't say, oh my God, this person wants to do something crazy, stagflation's coming, let me just blow up everything. No, there is a risk. There's a risk we've been talking about. But it's a risk you should be aware of, but right now you don't need to make any changes. Know what could be around the corner, prepare for what could be around the corner, but right now you can continue collecting your cash until we need to pivot. Today is not pivot day. Today is, hey, what could be around the corner? Now, speaking of what could be around the corner, is this. You want to continue to keep an eye on spending, okay? A few things you want to keep an eye on. All right, so we're moving closer to the holiday season now. Now, I'm somebody who is not a fan of putting up Halloween decorations in August and putting Christmas decorations up in October. Respect the holidays and the month they're supposed to be in. I hate it, okay? But in either case, do pay attention to where consumers are spending and who is spending. We've already talked about the 10% stat, how the top 10% are making up 50% of the spending, and that's not necessarily a good thing. But if they continue to cut rates, we want to see, is it really moving up spending? Who is really moving up? Who is pushing spending? And then where inflation goes, and if we can really trust those inflation numbers. That's what's going to tell us how strong or weak, however you want to look at it, the economy is. And if you need to move your portfolio closer to the defensive end near the end of the year. That's what we need to pay attention to now. Right now in September, October, and as we move into November. This right now is the season to start to research that. What most people think is, oh, when I get to December, what do I need to do? What do I need to sell? All type of stuff. No. Right now, gather that data, gather that information, because now you will have been studying for end of September, October, November, all of December. You've been studying that entire time and say, oh, I've subscribed to this channel. I've been watching this entire time, understanding this stuff. And now I know I've got me some dividend stocks. Now I know I've got me some defensive stocks. And now I have all this data information to get ready for 2026. And you already know. You're not going to be caught off guard. You're not going to say, oh, I need to get ready for something. You're already going to be ready. That's the entire point. You also want to keep an eye on job growth too. Are we going to be adding more jobs? It's usually the September surge where job postings are supposed to pop up a bit more with a lot of immigration policies and tariffs. I'm not entirely sure if that's the case either. We're going to see that as well. But those are the things you want to keep an eye on to tell us, should we shift more defensive as opposed to more tech, which we have seen majority of this year. We'll see. right? But again, collect that data now to start to get ready for 2026. You don't need to move your portfolio now, but right now is data collection season, so we can make those changes at the end of the year and be ready for 2026. So just like I've been saying, almost like a chessboard, we are already thinking ahead. That is how you stay ahead of the market, and usually, sometimes, how you can get better returns than most people. Again, why you should test out that subscribe button right there. But if you want to know other stocks and strategies that might work a bit better for you, you want to check out this video right here.